Welcome to this explainer of the Indian financial markets. You probably already have the basics down, but today, we're actually looking under the hood. We want to see exactly how capital moves, how it grows, and how it transforms in one of the world's most dynamic economic engines. So let's just bypass all the elementary stuff and break down the real underlying mechanics that power true wealth creation. Okay, let's dive into our roadmap for today. First, we'll look at the financial hierarchy of needs, then exploring your investment options. After that, understanding the IPO process, followed by navigating the secondary market, and finally, we'll wrap up with our Smart Investor Survival Guide. Section 1. Financial Hierarchy of Needs. So think of this just like Maslow's hierarchy, but, for your portfolio. Our financial journey is really an evolution. We built the base with simple savings, regular income, and insurance, just to protect ourselves, right? Next comes credit, borrowing and lending. But the absolute peak, the place where true wealth creation actually triggers, is making that leap into active investing and acquiring assets. For centuries, wealth basically meant hoarding physical gold or just locking up land. But over the last 400 years or so, we've had this massive transition. We went from literally burying treasure in the backyard to holding dynamic financial securities, things like bonds, mutual funds, and equities. And this shift is a total game changer because it unlocks massive liquidity, way more varied risk options, and it drives dynamic economic growth. Moving on to Section 2, exploring your investment options. And this brilliantly illustrates the core choice you face in the capital markets. You basically have two routes, debt or equity. If you buy debt, you're essentially a lender. It's a low-risk contract with fixed returns. But if you buy equity, you are an owner. Sure, you're carrying higher risk, but you're also capturing the upside, the profit sharing, and the capital appreciation. Now, if picking individual stocks feels a bit like a coin toss to you, the markets actually created the ultimate hybrid, the exchange-traded fund, or ETF. It pools money to give you that mutual fund-style diversification, but, and here's the kicker, it trades continuously on the exchange from 9:15 a.m. to 3:30 p.m., exactly like an individual stock. It really is the best of both worlds. But hey, if you want professional management, mutual funds offer a vehicle tailored to literally every single risk appetite. Chasing high growth? Go for equity funds. Needs stable, regular yield? That's debt funds. Maybe you're just parking cash for a week? Liquid funds are your friend. Or, you could just blend them together in a balanced fund for steady returns with moderate risk. There's for sure a flavor for everyone. Section 3. Understanding the IPO process. So where do shares actually come from? Well, they're born in the primary market. An IPO, an initial public offering, is that exact pivotal moment when a private corporation raises equity capital by offering shares to the public for the very first time. The relationship here is entirely direct. Your money flows straight into the company to fuel its growth, and in exchange, you get ownership rights. But mechanically speaking, how does a company actually price a share on day one? What exactly is book building? Now, what's really interesting here is the contrast. Historically, companies used a fixed price issue, basically dictating a single price up front. But today, modern markets largely use what's called book building. The company sets a price band, with a floor and a ceiling, opens it up to bids for a few days, and then allows a real-world investor demand to dynamically calculate the final fair issue price. It's literally demand in action. Section 4. Navigating the secondary market. Now, to actually participate in this market, you need to understand depositories. In India, we're talking about entities like NSDL and CDSL. The absolute easiest way to understand them is to just think of a traditional bank. But instead of holding your cash, a depository safely holds your investments, your shares, bonds, government securities, all in a dematerialized electronic format. This completely eliminates the old nightmare risks of losing physical paper certificates, or worse, dealing with fake securities. Let's see how this builds when you actually make a trade. Behind the scenes, clicking buy kicks off a strict 3-stage process. First up is trading. That's the actual placement of your order. Second is clearing, where the clearinghouse figures out exactly who owes what in terms of funds and securities. And finally, settlement. In India, this now operates on a super fast T+1 cycle. That means the clearing corporation guarantees that the money and the shares swap hands successfully the very next day. All right, beyond standard equity, we have derivatives. Now, don't let the name intimidate you. These don't actually hold intrinsic value themselves. Instead, their value is entirely derived from the fluctuations of an underlying asset. That could be a stock index, a currency, or even physical commodities. You see, massive macroeconomic forces drive these derivative markets. Take an oil futures contract, for instance. It allows businesses and traders to hedge against or speculate on the wild swings of global crude oil. The derivative itself is really just a standardized agreement trading on the exchange, constantly reacting to the real-world asset. In this space, you'll primarily encounter call and put options. A call gives the buyer the right to buy an asset at a set price. A put gives the right to sell it. The premise sounds straightforward enough, right? But actually, make no mistake here, these are highly leveraged, exceptionally high-risk instruments. They are really built for seasoned traders with deep experience, not beginners. Section 5, our Smart Investor Survival Guide. Multi-bagger stock. Guaranteed 2% monthly return. Subscribe to my channel for 5x returns. Look, we've all received these sketchy text messages at 2 a.m. Regulatory bodies consider this a massive red flag. It is the absolute hallmark of a pump and dump scheme or an illegal guaranteed return fraud. These schemes manipulate microcap stocks and basically prey on the greed of uninformed investors. Don't fall for it. So the crucial point is this, your definitive survival checklist. First, entirely ignore unsolicited tips, whether they're on Telegram, YouTube, or SMS. Just ignore them. Second, know that guaranteed returns in the securities market are strictly illegal. Third, treat your DMAT password like a signed blank check. Never, ever share it. Fourth, always check your statements after a settlement. And finally, never keep idle funds just sitting around with a broker. I can't stress this enough. Your absolute ultimate line of defense is communication. You have to ensure your mobile number, email ID, and address are constantly updated with your stockbroker. Why? Because the exchange and depository send direct automated alerts every single time a trade happens in your account. If a fraudster compromises your account, those instant alerts are literally the only way you'll know to immediately freeze it. So we've covered the evolution of financial assets, the menus of equities and funds, the primary IPO market, secondary trading mechanics, and the vital rules of survival. The structure is absolutely there for you to build real wealth. But the final question I want to leave you with as we wrap up this explainer is this. Armed with all this knowledge, are you ready to act as a calculated, informed investor? Or are you just going to gamble? The choice and the opportunity is entirely yours.